trading is really difficult, and even when you think you've got it cracked, it's always going to come round and kind of shake your confidence a little bit.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders podcast.
Hello, Darren. Welcome to the podcast. How are things in your world?
Hi, Walter. Yeah, I'm just kind of getting back to trading after quite a lengthy break, actually. I've been on holiday, and although I normally trade on holiday, kind of had a bit of a break this time, and really kind of switched off from trading completely. And it wasn't really a conscious decision. It was just kind of, I felt I needed to, I really wanted to just kind of stop reading about trading or talking about trading and thinking about it completely. And it's been quite productive for me. I feel refreshed. I feel really good for having a break. But also, I've been reading so much and trying to sort of improve my trading. It did kind of give me a bit of a moment to kind of look at things slightly differently. And, one little thing that's come out of that is recently I've been trying to find a way of, adding some diversification to my trading, because my strategy either works really well or in flat periods it works really badly. And I was sort of forcing myself to try and find a way of changing the strategy to kind of remove those bad effects, and this little break kind of made me kind of cleared my mind so I could think about it from a different point of view. So I'm kind of looking now at having separate strategies. So my strategy that I trade the most works really well when price is moving, when the markets are moving, and it doesn't perform so well when price is consolidating. So I've kind of started looking at those consolidation periods, and is there a way I can use my ideas but with a sort of slightly different approach that will work well in those areas. And I've noticed quite a few traders will have different strategies for different market conditions, and so that's kind of where my focus is right now. And I just kind of wondered what your take was on that. Should we have a strategy that we just kind of roll out in over the long term, or should we have strategies that kind of balance out the bad effects of each other?
Yeah, it's a good question. I guess most traders fall into the camp of either I'm going to trade both of these strategies. So one might be a reversion to the mean style of trading that should do well during a consolidation when the market's not really moving, just kind of flatlining and consolidating. And then you might have one like yours, like a kind of, I guess I would consider yours almost like a swing trading, or it's not really breakout. It's more like a swing trading where you're trying to catch these big swings, or maybe like a trend, you're trying to take bites out of the trend or something. So they kind of complement each other. But the question always becomes, are you going to try and decide whether or not you get to flip the switch and say, okay, we're consolidating now, so I'm going to trade my mean reversion system, or we're trending now, I'm going to trade my trending system, or whatever? Or are you simply going to trade them both all the time, knowing that one of the performance is going to suffer when the market's running off on and trending? Your mean reversion system is probably not going to do so hot. So it's tricky. What I've basically come to the realization is that I'm the guy that flips the switch. So what I do is I've tried to be the guy that trades them all the time, that trade these systems all the time. But instead what I do is I kind of take a step back and I go, okay, well, does it look like to me, and usually this is on the daily and weekly charts, does it look like to me that this market is trending? Does it have a clear direction? And if the answer is yes, then I'll go ahead and slap a filter on that, a system on that, and I'll see the market through a system's, through the eyes of a system, and I'll try and trade it like that. But otherwise, if it's directionless, I'll either go down to a lower time frame, or I'll just kind of, I don't really want to trade it. I guess consolidating on the higher time frame would be the way that I would say it. Like, even if a market's consolidating on a higher time frame, that usually means you could drop down to the 4-hour charts and find some trades where the market's bouncing off these different levels. So I tend to do that. But I typically, when the market gets really quiet, unless I think it's consolidating in the midst of a really strong trend, I typically will stay away from that market. So I guess that's kind of the way I view it. So I'm the guy that flips the switch and says, oh, okay, the yen's trending right now. I'm going to go ahead and look for, buy entries because it's going up. That's how I view it. But I know I would suspect that you would probably have a different idea. Like you would be trading both systems, I suppose, at the same time, not really trying to corner the market and say, well, it's trending now or it's not trending or whatever.
Yeah, well, I was kind of looking more at, so say when price is ranging, which is not good for my primary system. So when it's in a tight range, I was kind of looking at a system that would generate entries when that sort of price action is going on, but then when price does move in a trending fashion, that the system doesn't actually generate any entries. So I've been kind of looking at the way you set up the entry. You don't really have to make a judgment of whether the market's trending or ranging, because the entry system doesn't generate those entries when the conditions change.
Yeah, and that makes sense. So I guess you would basically see that the market's trending, and then you say, okay, we're going to use this entry now.
Well, just the secondary system just wouldn't generate any entries when the market's trending, because it would have to start ranging to actually create the conditions that would trigger an entry, if you like. It's not easy to do, obviously, and I'm slightly sitting on the fence of which is the best way to go, because with the traders I've been trading with this year, we've tried a lot of things that kind of rely on some sort of judgment or some way of kind of measuring the market and using that approach, and that's been fairly successful, but I just kind of feel it's not quite elegant enough. And there's the difficulty is whenever you're relying on your kind of judgment to measure the market condition, there's always going to be that element of doubt and subjectivity. However you kind of shake it, really, that's always going to be there. And my drive quite often has been to try and reduce those judgment calls as much as possible. Whether that's a good idea or not, I couldn't say, but it's just kind of my gut feeling of how I should approach it.
Yeah, exactly. Like, for example, when you get into automated trading, the big question always becomes, well, how do we define this? And, what sort of filter do we put on this? And so you've got to decide basically what is this type of market? How do you define that and that sort of thing? And I find talking to people who are into automation, they're always leery. The good ones are always leery of putting too many conditions on the system, and that's the tricky part, isn't it? Like so for example, for you, if you said, look, this is when the market's really moving, I'm going to get these entries. And when the market's not really moving at all, then I'm going to get these entries. But I guess the question is how, when how do you know? Like, how do you know?
Well, that's it. You need to kind of draw up some simple rules to sort of stipulate when you place your entries. And, this is always where you get the problem, because there's always going to be, let's say, for instance, my rule was price needs to make a new swing high, okay, before you set an entry. Then you get into the area of, okay, well, what defines a swing high? And how many bars are you going to consider that it is a proper retrace before the new swing? So you always kind of end up with those kind of annoying grey areas where, at the end of the day, like you say, you do have to make some judgment calls. And I think there's a lot of areas in trading that kind of have that, and some people do go down the route of automation and removing those grey areas completely. And I've kind of been driving towards that this year. And has it been successful? I'm still a bit on the fence, really. I think this year's left me a lot of unanswered questions, and I think I've made some progress as well. One thing remains that trading is really difficult, and even when you think you've got it cracked, it's always going to come round and kind of shake your confidence a little bit. It's like it is a continual battle, and I kind of really need to plan where I'm going to go go next year.
Yeah. I think you're right about the gray areas. I think I've been thinking a lot about automation too in the last 4 or 5 months, I guess. And getting into it, I find that what happens is sometimes you'll hear people say things like, I see something on the charts and then I go and code it up or have it coded, and then it's not nearly as good as I thought it would be, right? And I've been talking to a trader about this recently, and we've been going back and forth. It's like, okay, well, is this because you miss something and it's not in the codes? There's something that you're processing when you see these trades on the charts and it's not in the code. So the code doesn't actually reflect how you make these trading decisions. Or is it because we have these inherent, and we do have these inherent biases where when we scan through the charts, we kind of pay attention to the ones that are good, those good signals, and we kind of skate over or miss the ones that aren't so good. So that it could be part of that too, right? That's really what's going on, is we're not really paying attention to the losers.
Yeah, and when you actually kind of get into the coding, I think then you start to realize how much kind of feel and gut goes on in the background with trading. Let's say, for instance, right now, we could argue that after all the uncertainty, that the interest rates in the States are going to rise, and the dollar, is going to be in some sort of a long trend. That's kind of, to anyone with any sort of trading experience, that's kind of a bit obvious at the moment. But could you define that in some rules to put in an EA? There's a lot of gut there, and just kind of a feeling, right, well, the time is right now for the dollar to go on a bit of a trend. There's a constant argument of whether using your gut and your feel is the right way to go, or whether it's like a completely defined rule set.
Yeah, I believe that in the beginning our gut is awful. I think you can cultivate it as a trader, but I believe rather strongly that it, with very rare exceptions, if you are new to trading, and when I say new, I mean first 3 years at least, and you look at a chart and that chart says to you, yeah, I got to buy, I would seriously consider selling. because you're just not set up. I mean, we're just not, at least I don't know about you, Darren, but that's been my experience. And I keep hearkening back to the Turtles and how they were taught this. They were taught this, that their instructors told them. They said, look, if you got 2 trades and they're just as good as each other, and you can only take 1 signal because you're fully loaded, you can't take any more trades, you can take 1 more, and you've got 2, go with the one that you think is going to be the loser. Go with that one. And that was actually part of their rules, and I find that fascinating, because I think it's true. I think that it makes sense. You've got all these people with their wild emotions, and they're just going crazy in the markets, losing money hand over fist, and there's a few people that are slowly vacuuming up the money because they're a little bit more deliberate, they're a little bit more disciplined, and they see the market through a filter of a system. I guess it kind of makes sense that you would come to the party and just have no clue what's going on when you first start out in this stuff. I don't know. What are your thoughts?
Yeah, definitely. I think we come to trading with our natural biases and beliefs, and generally they are way off. And I think if anyone's been listening to the podcasts the last year, then we've kind of covered that ground a lot. We're sort of naturally bad traders, and I think a lot of trading is learning to sort of recognize those elements that we're bad at, and then building some sort of system and methods or process to avoid falling into those traps.
Yeah, so what do you do? I mean, let's say that you're an automated trader. Let's say that you're somebody that says, look, I know what my system is. I've got the rules here. It's all been coded out. I've back tested it. It looks great. This is going to be awesome. I'm going to make a bunch of money. Now, my question would be, when are you going to turn this off? In other words, traders who use these automated systems, they need to also have a set of rules about when, how do you implement the EA? When do you turn on the EA? When do you turn off the EA? Is it always going to be on? Is it going to shut off during the agent session? Is it going to shut off during interest rate announcements? Is it going to be, close trades before the weekend? How do you know what kind of drawdown before you say, okay, this is not working anymore? Like, all of these things need to be looked at beforehand. It's not just the discretionary trader that has to tackle these issues. Just because you've coded up your system and it's in a nice little EA box doesn't mean you're immune to all of these these thinking mistakes, these cognitive biases that we make, because we get sucked up into the emotions even if the robot's doing our trading. And these are the sorts of things I think that traders who are thinking about automating need to really consider. How are you going to interact with the EA? What are you going to do with your robot? What sort of tipping point do you get to where you go, okay, that's it, turn it off, it's not working anymore, you got to recalibrate or whatever? These guys, sometimes every 6 months or whatever, they're fiddling with the inputs and stuff like that. I mean, to me, that's funny, because what they have is a system that's perfect for the last 6 months, but now training it into the future, who knows how good it is? It's really sort of a tricky situation. But yeah, so I guess, what are your thoughts? I mean, how do you do this?
Well, firstly, the whole backtesting scenario, I think it's way more complex than we give it credit for a start. And it's so easy to find a system that backtests well over a period of time, but the variance that can happen in results seems to always remain. And so you can backtest something for a year, and then the next year it can perform completely differently. You can backtest it for 5 years, and then the next year it can perform completely differently. And I think we kind of give too much weight to its future performance. We have too much confidence in its future performance. I wonder whether diversification is not something that I've really looked into in the past, but I wonder whether we kind of focus too much on finding a single strategy that's always going to work. I'm starting to question whether that is the correct path to take. Do we need to be trading more systems with smaller accounts rather than putting all of our eggs in one basket, so to speak? I've not got the answer to that, but I find it hard to believe that say hedge funds would have like a single strategy. I could be wrong. My gut feeling is they probably don't. They might have like a preferred approach, but are they using a lot of diversification in their strategies to kind of deal with that variance? So if one system that has been working really well drops off, there's a greater chance that another one will kind of pick up the slack. What are your thoughts on that?
Yeah, absolutely. Yeah, so I think you're right. I think what I've been doing testing the last 3 weeks, and what I found is interesting. So, because this is right along the lines of your thought. All right, so you say, all right, I've got this system, it's pretty good, but I want to diversify. It doesn't work in all markets. And by the way, the best description that I've heard of the different types of markets are essentially quiet consolidating, so it's really kind of flatlining, not really moving much at all, just sitting there, or sort of a volatile consolidating, where it's not really moving anywhere, but it's a little more, it's a little bit more swing up, swing down, but still it's kind of stuck. Or you can have a quiet trend where it's very low volatility and just keeps marching on, or a volatile trend where there's some sort of deep pullbacks. And those are the sorts of markets that you see. You see, basically directionless or markets with direction. And so you've got to decide what kind of system do you have? Is it going to work in two of those markets? Is it going to work in one of those markets? How, when you test it, you need to test it in all those different types of markets. So getting back to your question about, what does a private fund do? How are they going to manage this risk? Essentially, you can trade different markets. So you might have one system and trade different markets, or you could trade different systems. And those different systems could be on different markets as well, or on the same market. But what I've found is interesting, that you're always going to be better off trading different systems, Now, why is this the case? So in other words, people will often say, well, I'm trading this system, but I'm trading on oil and on the pound, so I'm all good. Everything's fine. Well, what I found is that because basically it doesn't matter the market's either going to be trending in a quiet mode, not very volatile, or trending in a volatile mode, or it's going to be quiet and sort of consolidating in a quiet mode, not very volatile, or it's going to be consolidating in a somewhat volatile mode. Because all markets are going to be doing one of those things, your real advantage in terms of reducing your risk, which is basically what we're talking about here, comes with the approach of using more systems. Now, I agree with you. I think you're better off breaking off your accounts into smaller accounts and putting them at different brokers, because we've all seen, anyone who's been around this retail forex trading for any length of time, I've had 3 of my brokers go bust, which means basically you lose all your money. But fortunately, for whatever reason, in every instance, I didn't have money with that broker when it would actually happen. So Refco went bust, PFG Best went bust, and FXCM essentially went bust, and then the loan sharks came and saved him. And I had accounted all those brokers, but for whatever reason, I had pulled it before the ultimate. When the house of cards fell down. So I was lucky, but I might not be so lucky in the future. So I think it makes sense to break it up beyond that for broker diversification as well. So that's basically what I found, and I would recommend that if you're testing this idea of what to do I trade different markets with the same system or different systems? I've found that different systems will usually provide you more advantage in terms of smoothing out your equity curve. And of course, you need systems that are complementary. You can't have 2 trend following systems. So I'm talking about a breakout system and a trend following system, or a breakout and a reversion to the mean, or a swing system and a scalping, or whatever you want to call it. That's basically what I've found. So and I'm not saying this is the be all end all answer, but I think that if these are the lines of thinking that people are going through, I think I would encourage you to test it out for yourself. But so far, I haven't really been able to find anything better than essentially adding more strategies rather than more markets.
Yeah, and I find that this year, where price has been fairly flat in one market because of, say, some fundamental reason, it's kind of gone across all markets. And even though there might have been some that were still moving, they still were kind of a bit sluggish and not really kind of making up for the really flat markets. And I've kind of come to the same conclusion that really I kind of need some more strategies. And it's quite difficult because there's kind of notion that if your strategy works, it should always work. And if you start looking for another system, that's kind of got some negative connotations. And really it hasn't. You're just kind of being smart and diversifying for the different market conditions. So that's kind of encouraging that you agree with me on that. And I have been sort of listening to recordings of who've been around a long time and traded a long time, and it seems nearly all of them have multiple systems as a way of diversifying. And I very rarely heard them talk about changing markets, and unless they're in a completely different ballpark, so picking a different currency pair, I've never heard them mention that. So yeah, that's quite encouraging.
Yeah, and some of these guys, they just trade in like indices or whatever, or stocks. And if you're trading, it doesn't really matter if you're trading the FTSE or the S&P 500 or the DAX or whatever. A lot of these markets are pretty correlated. If you look at the correlations, what you'll find is more or less when the DAX goes down, the S&P goes down, and that sort of thing. And you're going to find areas of divergence when it's not the case. But so what these guys are just absolutely terrified of is they have so much money, they have to place it in all these different markets, right? So then what happens is if there's some sort of a crash, they're screwed because all their stuff is in there. So that they have to diversify by system. They have to have different systems. And even the same thing, like if you're trading the index, okay, and you're long the S&P 500 and you've got all these stocks that you're also long, even if they're not even if they're sort of like emerging companies or whatever, they're also going to be correlated to the index too. Generally speaking, when the index is up, they're going to go up. Most stocks will go up. So this is the sort of thing that you have to think about. And so what most traders, like you say, what most traders have found out is that it really makes sense to figure out, okay, this system that I really like and I've been trading it for so long, it works in this kind of market. But what would a system look like didn't necessarily, maybe works in the opposite type of market or a different type of market that's going to be really challenging for my main system, and so they add there. So I think that makes a lot of sense. If you don't have any ideas for systems, my advice would be go into Forex Tester, just watch the charts and see what you come up with and see what you notice. I was talking to a trader the other day who said, he basically realized like he had these rules for a system that he was testing, and then he saw something else kept happening so often in Forex Tester. He finally said, screw it. This is like, I've got to add this, this is a new system. And I think that's what you'll kind of find if you spend a lot of time getting your hands dirty with the data. You'll eventually come up with some ideas to test because you'll see something happening over and over again. Now, for me, obviously, that's just price patterns or whatever, but it might be something else for you. It might be the way that price interacts with moving averages or the MACD interacts with moving averages or whatever. I don't know, but it'll be something that will just jump out at you and say, well, this makes a lot of sense. And to me, that makes much more sense to go down that path than to open up some book and go, oh, well, this guy says this works, and then I'll just use that. No, it's better off if you come at it organically, where you come up with the rules based on what you see, because now it's built on the foundation of what you see about your beliefs, and it's a little bit harder to shake that than it is to shake what someone gives you and says, oh, this works, go ahead and use it. So yeah, that's what I found anyway.
Yeah, I think a lot of people end up, people who eventually become successful, I think a large percentage of them end up doing that, eventually bringing everything together and making their own kind of unique board, if you like, to play on. And I heard something good the other day. He said most edges lie in the places where other traders aren't looking, and that's kind of where you need to go. You said something earlier as well about different time frames. I find that's quite a good way to diversify as well. There's a bit of an issue with managing trading on two different time frames at the same time, but something like a daily time frame strategy with say a 15-minute strategy that you use intraday at sort of the peak market times. Something like that can work really well, and I've noticed that in my group, where some traders are trading daily and others trading the 1 hour time frame. And when the daily traders aren't doing so well, the lower time frame guys seem to kind of make it up. So that can kind of work quite well, mixing two different time frames.
Yeah, absolutely. Yeah, so it's a different system though in the end, isn't it? Or is it the same system that they're trading on different time frames?
I think it's the same core system, but just kind of modified to suit the time frame. Really, the core idea is the same. So let's say they're both trend trading ideas, but they'd have different sort of methods of entering and exiting the market.
I believe that it's always sort of trending somewhere. I mean, if you look at 1 hour chart and you say, well, this chart's so choppy, but if you broke it down and looked at the 5-minute chart, you might see some beautiful trends.
Yeah, exactly. Yeah.
In other words, I guess there's always a market. You know what I mean? Like you can always find a market. Like there's never, the excuse should never be, and people who overtrade can tell you this. The excuse is never like, okay, there's nothing to trade, right? There's always, if you're a trend follower, and you can't find any trends, well, look in a different time frame, that sort of thing. But I hope you have your data to back up that it works, that your system works there, because you might have to tweak it. Yeah.
And that's something else that I think perhaps we don't do enough of, is like you were saying, you can always find a market. I think we're kind of drawn to deciding, okay, well, this is the strategy I'm going to trade, and I'm going to trade it on the pound, yen and gold, and you back test it on the pound, yen and gold, and you kind of get locked in to sort of that being how you're going to trade. I think perhaps sometimes it's a good approach, like you say. I notice stock traders do this a lot, is to, perhaps look at the markets right now and say, right, well, this particular market is performing best for my strategy right now, so I'm going to trade that one. I know you do this. You look at all markets, you look at all currency pairs and crosses, and you can quite quickly decide, right, this one kind of looks right, it's moving the way I want it to see, and then you go and look for possible entries there. And I think too often traders kind of decide, right, I'm a euro dollar trader and this is the strategy I'm going to trade, and they kind of just do that. And sometimes it's glaringly obvious that the euro dollar is not moving in a way that's good for your system, but there's this kind of negative aspect to making changes. And I think all good traders are constantly having to sort of make some changes, perhaps adjust like parameters, adjust how they're managing, and look at perhaps trading a different market for a while.
Yeah, I mean, I think it makes a lot of sense. You can certainly lock into one. I know some successful traders who do that. They just go, look, this year I'm just going to trade the pound yen, and they have their reasons for that or whatever. But I think, to me, it makes sense to open it up, because otherwise you could be reaching. Like if you're just trading the pound and your system doesn't work when it's consolidating, and it's kind of consolidating, well, should you really be trading that? Maybe you should just open it up. And what's the New Zealand CAD doing? What's the Aussie yen doing? Is there something else going on here that's... And, like for me, if I'm looking for a trend, there's a very typical trend I'm looking for, which is a quiet trend that looks really strong, kind of moves up and then consolidates and then moves up and consolidates. I don't like the ones that do the deep volatile pullbacks. Those aren't really the ones I want to play with. I want to play with the friendly ones that are really easy, And so it's more, I guess for me, it's more the look of a chart. But some traders, they like the idea of trading their home currency or one that they feel like has a better spread, which I think is the horrible reason to choose a market. I'm going to trade the euro because I get a 0.5 pip spread. That's like a terrible reason to trade. But whatever. Some people, that's the way they approach it. Yeah. All right. So any closing thoughts, Darren, or are we all wrapped up here?
No, I think we've covered some good stuff there, and that's kind of where I'm going to sort of go through into the new year. I'm going to try and sort of work more on diversification with my trade.
Cool. Sounds good. And we will see you next time. Maybe next time we can talk about, I don't know if you want to do this, but something I've been thinking about is flow, trading with the flow. So maybe we can talk about that next time.
Yeah, that sounds cool. Good to be back, Walter.
All right, great. See you soon. Bye.